Hi everyone, today we are going to be talking about the history of currency and the development of modern central banks. But before we get into, let's start by defining what we mean by currency here on Stairs. Currency is a medium of exchange that is used to facilitate trade and commerce. It can take many forms such as coin, paper money, or even electronic money stored on a credit card or phone. Now, the history of currency is a long and complex one, with different civilizations using a variety of materials as currency. For example, the ancient Egyptians used grains and livestock as currency, while the ancient Greeks used coins made of gold, silver, and other precious metals. As civilizations grew and the trade became more widespread, the need for more standardized forms of currency arose. This led to the development of paper money, which could be easily transported and exchanged for goods and services. The first known use of paper money occurred in China during the Tang dynasty. Around the 7th century AD, the story of paper currency in China begins with the Tang dynasty chancellor Li Mi. Li Mi was a government official who was tasked with the job of finding a solution to the problem of transporting large amounts of coins across long distance. At the time, metal coins were the main form of currency in China, and it was difficult to transport large quantities of them. Li Mi came up with the idea of using paper currency as a way to solve this problem. He proposed that the government issue paper notes that could be exchanged for metal coins. These notes could be easily transported and they could be exchanged for coins at any time. The Tang dynasty government agreed to this proposal and began issuing paper notes in the year of 618. The notes were made of mixture of mulberry bark and cloth, and they were printed with the government's seal to ensure the authenticity. Paper currency was not widely used outside of China until much later. It was not until the late 17th century that paper currency began to be used in Europe. And it was not until the 20th century that it became widely used around the world. The first European country to adopt paper currency was Sweden, which began using paper notes in the late 17th century. Other countries in Europe, such as France and England, followed suit in the 18th century. In the United States, paper currency was first issued by the Continental Congress in the 1770s, but it was not widely used until the 20th century. Today, paper currency is used in many countries around the world. It will be very interesting to know what does AD mean and what the word stands for through the link which will appear here. But as economics grew and became more complex, there was a need for more sophisticated financial systems to manage the supply of currency and to ensure that it maintained its value. This led to the development of central banks. Central banks are financial institutions that are responsible for implementing countries' monetary policy and for regulating the supply of money in the economy. They are usually owned by the government, and they play a crucial role in managing the stability of countries' currency and the financial system. The history of central banks is a long one, with the first central banks appearing in the 17th and 18th centuries. The Bank of Sweden, which was founded in 1668, is often considered to be the first central bank. Other early central banks include the Bank of England, which was founded in 1694, and the Bank of France, which was founded in 1800. These early central banks were responsible for managing the government's finance and for issuing paper currency. Certainly, the Bank of England is the central bank of United Kingdom and was founded in 1694, as we mentioned before. It was established to act as the English government's banker and to this day is still one of the world's oldest central banks. The bank was privately owned and operated for much of its history, but it became nationalized in 1946 after the World War II. Before completing the story of Bank of England, please like, subscribe and share for the helping of still continue providing these interesting episodes. And please also click on the notification bell. The Bank of England was originally established to act as a lender of last resort to the government and to issue banknotes. It was given the exclusive right to issue banknotes in England and Wales in 1844, and it still has the right today. The bank also acts as a regulator of the UK financial system and sets monetary policy in the country. In 1997, the Bank of England was granted independence from the government in setting monetary policy, which means that it is able to make decisions about interest rates and other monetary policy tools without interference from politicians. This has helped to improve the credibility and stability of the UK's monetary policy. The Federal Reserve, also known as the Fed, is the central bank of the United States. It was created by Congress in 1913 in response to a series of financial panics in the late of 19th and the early of 20th centuries. The Fed was designed to serve as a lender of last resort to banks and to help stabilize the financial system by providing a source of credit during times of economic crisis. The Fed is made up of 12 regional banks that are responsible for carrying out the policies set forth by the Federal Reserve Board, which is a 7-member board of governors appointed by the President of the United States. The Fed has several tools at its disposal to carry out its mandate, including setting interest rates, regulating the supply of money and the credit, and supervising the banking system. One of the key functions of the Fed is to manage the inflation and to maintain price stability in the economy. It does this by setting target for the key interest rate called the federal funds rate, which is the rate at which banks lend money to each other overnight. The Fed can raise or lower the federal funds rate to influence the supply of money and the credit in the economy, which in turn affects the overall level of economic activity and inflation. You can check what is inflation from here. In the 20th century, many countries established central banks as part of their efforts to establish a stable monetary system. Today, central banks are found in most countries around the world, and they play a crucial role in maintaining financial stability and promoting economic growth. Again, central banks have a number of responsibilities, including setting interest rates, regulating the supply of money, and serving as lender of last resort to banks in times of financial crisis. Now, let's talk about another advanced model of currency, which is digital currencies, also known as cryptocurrencies. Cryptocurrencies are digital assets that use cryptography of security and are decentralized, meaning that they are not regulated by any central authority, such as central bank. Bitcoin, which was launched in 2009, was the first and still the most well-known cryptocurrency since the creation of Bitcoin. Many other cryptocurrencies have been developed. Some of the most well-known include Ethereum, Litecoin, and XRP. Cryptocurrencies operate on a distributed ledger technology called blockchain, which allows for secure and transparent record keeping of transactions. Cryptocurrencies have gained popularity in recent years due to their potential to disturb traditional financial systems and because they offer a potential for anonymity and security for users. However, cryptocurrencies have also been the subject of controversy. and have been associated with illegal activities such as money laundering and fraud. As a result, the use and regulations of cryptocurrencies varies greatly from one country to another. So that's a brief overview of the history and the future of currencies and the development of modern central banks. I hope you found this informative, and be sure to stay tuned for more videos on stairs.